Aditya Suresh is Managing Director and Head of India Research, Macquarie Capital. Aditya, good morning. Good to have you here. Thanks for joining us. On paper, Aditya, if we can put it that way, right, across sell-side research houses, the view is turned. And most are expecting a better 2026. The reasons are well discussed and well documented. I sometimes wonder how much of that has got to do with the fact that, well, we've got sort of, we've spent enough time doing nothing and we've seen some price damage, and the fact that the year is turning. So maybe, hoping for a better year ahead, and how much of it is just based on fundamentals and valuations, etc. Because valuations across the board have still not come off. I mean, the premium compared to EMs, etc., has come off a little bit, and those kind of arguments one can make. But on an absolute basis, across the board, valuations are not a screaming buy or anything. So how do you look at things, Aditya?
Prashant, thank you for having me on the show. If I just take you back a little bit, Prashant, so at least Macquarie, our view into this year was far more cautious than where the market view was at. And it was pinned on a few aspects, right? And it largely was on kind of where expectations were at for earnings, right? And across different sectors, one of the key points we were trying to make was that, we're going to see these cuts for us to kind of absorb and digest as a market. Now, through the year, we've kind of seen a lot of that kind of come in. In our recent piece, Prashant, now there is an element of looking out 1 year at a point in time. We kind of do these outlook reports, but the point we're trying to make is that when you kind of go back to the same framework, today where we are from an earnings perspective, I think there is an element of support here, right? Because the cuts already largely reflected in the numbers is our expectation, or at least that's our sense. And to the extent that's correct, then we're really going to be coming off a phase where last year, for example, of fiscal 26, we said no growth, right? Your revenue growth was about 5%, so GDP minus. Underneath that, you've seen some margin erosion. So PAT growth has been tracking below that 5%. In response, you've seen the cuts. But to the extent that now we're feeling more optimistic and comfortable with where expectations are at least the broader dynamic here is about us getting back towards that mid-teen pace of growth compared to it being absent, right? So you're trading at this high valuation and no growth. And when you then think about that versus kind of broader emerging markets, you'd see this phase where markets like Korea, Taiwan, all these things, estimates are being meaningfully revised upward, right? And so somewhat kind of counterintuitive perhaps, but you had this high PE multiples for India with no real kind of relative growth premium, which has been a fairly problematic dynamic for India as a market to kind of work through. And the point we're trying to make here is that we do feel that earnings coming back is going to then mean that foreigners also potentially come back to India as a market. That'll be a support factor here. But again, it's the entire theme about kind of this growth recovery. So I think things have changed, Prashant, in terms of what's in expectations. Feeling more comfortable about kind of what's in expectations for fiscal 27, fiscal 28, and that underpins a lot more of that positivity. Underneath that, in terms of stocks, it's very selective, bottom up. There's no specific sector tilts necessarily.
No, well put, Aditya, and thanks for explaining that. No, I was just, no one wants another tough year. So sometimes at the end of the year, you're just, rooting for a better 2026. But well, there are reasons to do that as well, as you explained. And let's, I guess, get into some stocks, sectors, etc. Surabhi.
Yeah, absolutely. Aditya, hi, morning. I just wanted to go back to that earnings point before we talk sort of more specific names. You're saying, and that's an expectation we've had for several quarters, right? We start the year with expectations of 12-13% growth, and then those expectations are tapered down. So now, halfway down the year, what is your earnings projection for this year, and more importantly, FY27?
So I think fiscal 26 in itself, just this year, I think is less relevant from a forward-looking perspective for markets. I think just to establish the point, if we start there thinking about, say, fiscal 26, we're going to get some nominal GDP plus X kind of EPS growth. That's clearly not been the case, right? So even revenue growth in nominal terms has been below GDP, and underneath that you see that margin erosion comment. So it's tracking at, say, maybe 2-3%, depending on kind of which index you're looking at and how you're adjusting for one-off items. Looking at fiscal 27, fiscal 28, when we do the bottom up and thinking about what growth is, at least we're forecasting, we're in that, say, mid-teens kind of a pace of growth. We're not been in that kind of that trajectory for some time now. But you're correct that there is a bit of a departure in terms of the spot comment is one where growth is really, really anemic. And the expectation is that this recovers. But when you then do that across different sectors, take financials, for example, like our team in the financial side, they are speaking about credit growth in the high teens. Maybe you get some margin expansion as well. We'll see. That alone is, say, for example, 30% of MSCI India. The IT sector, at least our analysts are a bit more optimistic than where the street is at on revenues and margin. So when you get to do that and go through across different sectors, we feel a bit more comfortable. And that is a meaningful departure from where our mindset was 12 months back.
So this mid-teens growth for next year, FY27, broadly speaking, if I were to ask you, what will lead it? Financials, like you mentioned. What else? I mean, just looking out next 12 to 14 months.
So it's just purely from an aggregate perspective. It's largely financials. Industrials is a big part of the story as well. Materials is part of the story. With the consumer names, it's more revenue and margin as well. There's this operating leverage comment, which is kind of embedded. Healthcare is a bit more idiosyncratic. Telecom is going to be some really good headline EPS growth still, because that sector, the kind of interest burden is still high. And so as this operating leverage kind of comment plays out, then you still see that growth coming through. But broadly speaking, we are feeling more comfortable in terms of what's in expectations right now.
Okay, all right. Hi, Aditya. Good to see you in. But short point being, going by all that you said, you're saying that 2026, we should be leaning more towards 30,000 rather than 20,000. I think that's the big takeaway, right?
Well, that was the one-line kind of catch-all kind of comment. But and that wasn't our mindset 12 months back, right? So we're far more kind of cautious. And just to kind of preface this a little bit more was that when you take this back to even Prashant's comments about valuations, the point about valuations still holds that in absolute terms or in relative terms, India as a market is still excessive when you look at it on its own. But the way we think about that valuation comment in itself on, say, the next 12 months is that to the extent we are correct that foreigners are going to be coming back to India as a market, and to the extent that domestic liquidity is going to hold, it's almost as if then the only clearing function is then the IPO side, right? But overall, on balance, if those two aspects are kind of in our favor, then I think these multiples could further expand despite the high starting point.
Okay, all right. Let's get into a couple of sectors then. The EMS space, that's gone into a bit of a funk actually. It was the big theme, maybe getting into 2025. But this year has had a share of problems for a couple of companies. You all believe that things are ripe, it has a longer runway, and things will improve from here on? If you could tell us what's your view?
Yeah, so our analyst who covers the EMS stocks, so he's still optimistic on the likes of, say, for example, Dixon, Avalon, these seven names. It is still coming back to that dynamic where, at least when you have this thematic which is at play, but I think the broader dynamic is that when you think about this as a combination of growth, returns, and free cash flow, all three dimensions are kind of working well for that sector, at least in our bottom-up estimates for our analysts. And so that still keeps us optimistic on selective names.
Got that. I hope this is what you're saying is absolutely correct. Talking about the paper supply, right, which is coming through. Akash Prakash in an article yesterday wrote, well, that's one of his caveats. He also thinks it's going to be more constructive in 26 over 25, but with caveat that investors regulate themselves with regards to the paper supply which is coming in. And by the way, talking about paper supply, I think Meesho listing today, it's a big one. And I'm being told that there are some visuals coming in from the exchange, and we have the MD, CEO, the founder actually speaking at the Meesho listing. Maybe we'll play, show some shots and what's happening there. There's one more listing, Acus, which is also an interesting company in the defense aerospace arena, which also got subscribed pretty heavily. Just your own thoughts, Aditya. There are various ways to cut this, right? Equity issuance as a percentage of market cap, and you look at where this was in previous market phases, and where we are now. Some say, well, it's at a point where it can overwhelm the market. But of course, I mean, the fact is that one important cohort, which is FIIs, are kind of missing out of the picture. So just your thoughts. Is it likely, if the supply stays so strong, that it could overwhelm markets?
I think just on the supply in itself, the one comment I'll make is that there is a bit of a red herring comment which I think we're missing, which is that a lot of the supply is coming in with the promoters, the PE, VC, predominantly cashing in, right, rather than being used to kind of being deployed towards growth capex. So that's a red herring comment, and obviously kind of all that is in response to these valuations which are available in the market, which are rich. So having said that, I think the broader dynamic is that, so to the extent that we have domestic liquidity holding at current levels, and to the extent foreigners did come back to the market, Prashant, as you kind of mentioned, and at least that's our expectation as well, then India, which has been this roughly about $20 billion IPO market this year, last year, conditions would still support that. We'd much rather see the capital being deployed elsewhere and more towards constructive purposes on, say, capital formation. But having said that, yeah, I mean, so could you support $20 billion of activity in any given year, even next year? I think the liquidity supports that.
Liquidity supports that. And we'll see how this one plays out. By the way, do you have coverage on Indigo, Aditya?
So Macquarie, we don't cover Indigo, Prashant. We do cover the OTAs, so I can maybe speak in that lens, but Indigo is a stock which is not in our coverage.
What about the EMS space?
EMS, we just discussed it. That is an area which we covered by a different analyst on the team. We are optimistic on those names, despite the headlines which you've seen on one of the players in the past couple of days. We're still optimistic on the growth headroom which these companies have, margin expansion. So it's a mix, right? Growth, returns, and free cash flow, all above 20%, at least on those vectors, is our outlook.
Aditya, let's then round it up with a sector that you're really optimistic on, and that's financials. We briefly touched upon it earlier. That's a very large universe. So leave us with a slightly narrower approach in what part of financials, lending, non-lending. And then these capital market plays are so interesting. They created a lot of wealth, but now they're probably among the most volatile parts of the market because of evolving regulations. So just tell us, what's your order of preference within financials?
So our analyst who covers financials is Suresh. So he is still fairly selective in terms of his preferences. And so it's still more the large private banks. So that there's a bit of that, let's say, quality bias, safety bias, if I may, within that comment. So he's still more the private banks over the public sector banks. He's feeling still more constructive on your HDFC and ICICI Bank. Incrementally, a little bit more optimistic on maybe NBFCs and insurance as sectors. Capital markets, that's a gap in our coverage. So not really making a specific comment on that, but these are good operating leverage businesses, right? So you can see how the changes in kind of whether it be regulations or be just volatility on a daily basis does impact that sector quite a bit. But if I rank sort, it's private banks, NBFCs selectively, then the PSU banks, at least for our financials team.
Okay. All right, Aditya. We will leave it on that note for this morning. Thanks very much for joining in. Good to get that perspective. And now wish you season's greetings and look forward to more conversations in 2026. Thank you for joining in.